This is a lifestyle. You are an investor. And that's why you have the right strategists on your team to help you plan for these options and these great scenarios that you could get yourself into, but to also avoid the pitfalls of owing a lot of taxes in the future. To understand the cost segregation, you got to understand depreciation in general. So generally speaking, if you're buying a single family home, right, or a 1 to 4 family property, you get to depreciate the building over 27.5 years. So let's just say it's a $275,000 property over 27.5 years. We're equaling roughly $10,000 a year. So 27 and a half years on a 1 to 4 family property over 27 and a half years, $275,000 purchase price is $10,000 a year. Now again, in this scenario, we're equating zero value to the land, but you're not allowed to depreciate land. So this is the start point. 27 and a half years depreciation on a 1 to 4 family residential property. Now, so commercial property depreciation is over 40 years. These are tax rules. Now, if you have the same $275,000 building and you're depreciating it over 40 years, again, we're assuming land value is zero, which is not realistic, but to make the numbers simple, you're depreciating $6,875 a year. Again, depreciation is a paper loss, and now you won't have to pay tax on this portion of income. Or if you're a real estate investor, you can use this deduction or reduction against income elsewhere. So there is benefits to depreciation, and most of the time the benefit is because you're paying a mortgage, and the principal pay down of a mortgage is not deductible. So you would have possibly a gain because now you're showing the number that the income that you're getting in, because you can't write down principal, on paper will seem higher than the actual cash you have. When you account for depreciation, it usually balances. So I'll recap that. 27 and a half years for residential real estate, $275,000 price, over 27 and a half years, roughly $10,000 a year. Commercial real estate is depreciated over 40 years. On the same 275, you're getting $6,875. Depreciation helps offset the income that's being paid out for principal of a loan. So that's another reason why it's generally accepted. Now, what is the benefit of regular depreciation compared to a cost segregation model? To simplify it, it is more aggressive, more benefit. Let's look at the benefit. So with cost segregation, we get an engineer, and this engineer has his own opinion, and this is why it's allowed. The accountant doesn't make this opinion, the engineer makes his own professional opinion. He will take this property, well, let's just say it's standard as a 40-year property, and he'll take the property, the $275,000 of value in this commercial property, and he'll break it up into different sections. So these are 5-year useful life items. We're gonna say carpet, maybe laminate flooring, all of the things that don't have a very long life, paint, and then these 5-year items will say roughly $50,000 of this asset is these 5-year items. He'll then have 10-year items. We'll say drywall, maybe cabinets, and other things like that. Those will be another, we'll say, $100,000. We'll then have the next section, which is 15-year life. 15-year life could be things like roof, plumbing, water heater, AC, depending on the type of product you have, your water heater could be a 5-year, 10-year, or 15-year, depending on which one you bought. AC units are generally 15 years, roofs are generally 15 years. So we'll just say another $50,000 goes to that. And again, these are not 100% accurate. We would have to then, the engineer would determine which is accurate numbers. And then lastly, the 40-year item would be, in this situation, be about $75,000 worth of items. So we broke down this $275,000 into the sections of the building. Really simple. How long is this stuff gonna last? $50,000 of stuff is only gonna last 5 years. $100,000 is gonna last 10, 50, 15, $75,000, 40 years. So that's pretty simple, right? Just how long is this stuff gonna last? And because it's only gonna last 5 years, we can then depreciate it over that 5-year term. So how much depreciation we would get would be this item. Here in this example, we can see that the total depreciation, $50,000 over 5 years is $10,000 per year. $100,000 over 10 years is $10,000 per year. Again, this is a very simplified model, how it works. The total depreciation for that year is $25,208. So you can see that this is significantly more than the $6,000 on the 40-year depreciation model or the $10,000 on the 27.5-year depreciation model. You can get more depreciation, reducing your income, reducing your tax burden. Now, point 1, if you are gonna depreciate this over 5 years and you will not have a recapture if you depreciate over the useful life of the item. That is the good part, unless your depreciation is not accurately matching the model. But if your engineer does it and you follow it, it should match the model. Now, the next option, there's even a more aggressive option with the cost segregation model. You can use bonus depreciation, and since we have these bonus depreciation rules, it's very helpful to use them when you can. So how does that work? How does using bonus depreciation with the cost segregation model? Anything under 15 years, or 15 years or less, there are certain rules that allow you to write them all off year 1. So with the cost segregation model, using bonus depreciation and applying it in the correct situation, you would be able to write off $50K, $100K, and $50K year 1. So in this made-up scenario, you would be able to write off $201,875 in this made-up scenario. So you could get the gravity, the benefit of being able to use the cost segregation model with bonus depreciation. Now, here is some reality tips. 1, normally speaking, your down payment on a property, it's roughly 70 to 80% of your down payment initial costs. You'll be able to get them back in a bonus depreciation scenario. So you're not really gonna get $200,000. If you bought the property for $300 and you put down roughly, say, $90,000, you'd get 70 to 80% back of that $90,000. That's really closer, not 80% like in this scenario. Could this happen? Yeah, it could happen. Like in a mobile home park type situation. But in a concrete block building and so on, it's not really likely. Now, here is my warning to you. Here's my warning. Obviously, there's double-edged sword. There's pros and cons. So everything can be used for your benefit. Just gotta be cautious how you use it and make sure that you have your tax strategy in line. So if you depreciate these items, you bonus depreciate these items, and you get them as a reduction on your taxes. If you sell this property before 15 years, there's a thing called recapture. So here is the explanation here with recapture. If you sell a property and you sell it before 15 years, say you sold it after a year. In year 1, you took all this depreciation in the previous example. But in year 2, you sold the property for 300 grand. In a normal scenario, if you didn't depreciate the building at all, you bought it for 275, you sold it for 300, you have $25,000 of profit, and it would be long-term capital gains because it's over a year. So you would be, let's just say 15% bracket for this taxpayer's example. This is what's standard with no depreciation on the property. If you depreciated the building and you took the standard depreciation, right? Scenario 2, you now have a scenario 2 is the standard depreciation 27.5 years. We said that you took $10,000 as a depreciation. So you sold it for 300, you purchased the property for 275, and you took $10,000 as depreciation. So now 275 minus 10 is 265 remaining value of the building. Because you told the government, hey, it's worth 10 grand left after 1 year. So you would owe tax on the difference between 300 and 265, which is $35,000. And because you depreciated it over the useful life, there isn't recapture. You just pay the standard capital gains. Again, 15%, but on the $35,000 worth of gain. Again, you could do a cost segregation model, you could do other things to roll this gain to another property. But what happens with cost segregation models, if you get caught into recapture, in the third example, so let's just say here, cost seg, you have 300K minus the depreciated value. Well, in this depreciated value, you have 275 purchase price and you depreciated, let's just say 200K. Again, not a real scenario, but let's just keep the number simple. You would have to pay income on the difference. So if in this example it's 265, you would have the 10K, or you would have the 35K actually, and this is what they calculate what should have been your income. You would have income of 35K as a long-term capital gain at the 15%, we'll say. But what would happen is when you depreciate something faster than you should, and then you end up selling it soon, before your 15-year period or 10-year or 5 period, there's a thing called recapture. Because you're recapturing it and you have the opportunity to write off the extra 200 or the extra, in this example, $190,000, because you wrote off the extra $190,000 of depreciation, in this example, you're required to recapture it. And because it's extra 190 the year prior, you could have used it to write it off against earned income. The IRS will tax you on this recapture as earned income. So you have to be careful when you're doing this because you could expose yourself to recapture. You have to make sure that you're going to be, if you're selling this property, you're rolling it into another purchase that can give you a significant tax write-off, or you're doing a 1031 exchange. You're doing something to avoid having this happen to you. So this is not to scare you. This is to open your eyes and your mind up to this idea and this ability that you do have the benefits of a cost seg, but you do have a double-edged sword, so you have to be prepared that this is a lifestyle. You are an investor. And that's why you have the right strategists on your team to help you plan for these options and these great scenarios that you could get yourself into, but to also avoid the pitfalls of owing a lot of taxes in the future. So the tax right here is gonna be 35K, because I'm saying 35K is a long-term capital gains because this would have been in a standard scenario of standard depreciation over time, okay?
When you're doing the 275 minus 200K.
So 275 minus 200K is 75K. 75K gives you $225,000 of taxable income. 35,000 of his long-term capital gains, 190,000 is earned income. So this is accounting for the full 225 right here between these two. So it is a total of, great question, the total is 225,000 of taxable income, but it's split up in two scenarios. One, long-term capital gains at 35%, 35,000, and 190 at earned income. So you could see it can get complicated, but those are what the professionals are for. Now, I want to avoid this. Well, why? Because if you can benefit $190,000 write-off against, $500,000 gain somewhere else, this is fine. You just got to make sure that you're planning ahead. All about planning, strategy. Same thing with investing. You can't just buy something today. You got to think, what is the plan? What is the strategy? What's the goal? How's it going to blend in with what I currently have to benefit me long term? And the longer you think out, the better you are at getting benefits from your investment strategy.
Real quick, how does someone go about saying, I want to do a cost segregation model when I buy this property? Do they just say it?
Yeah, they get an engineer to do it.
Okay.
You pay someone to do it, and then you give that information to your accountant.
To your accountant. So your accountant is the one who breaks this all down.
Well, the engineer breaks it down,
Yeah.
and then the accountant takes this information, applies it to the rules, and then you and your accountant would strategize, do I actually bonus depreciate these, or do I just take them over the useful life? What am I going to do? Maybe I'll only take 5 years as a bonus depreciation, not the 10 and 15 year options.